Covered call ETFs have gained attention for their potential to generate attractive yields. However, behind this potential lies some risks that are not obvious to investors at first glance. In this episode, ETF portfolio manager Chris Heakes explores the appeal of covered call ETF strategy, the potential pitfalls of high yield promises, and the critical nuances that every investor should understand. You're watching Inside Investing. Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Caitlin Cormier. Joining us is Chris Heakes, ETF portfolio manager from BMO Asset Management. Chris specializes in developing and managing ETF products. He is a CFA charter holder and also holds a Master of Finance from the University of Toronto. Chris, welcome to the show. Great to have you here with us.
Thanks, Caitlin. It's great to be here.
Chris, what was it that drew you to the ETF world in the first place, and what has kept you there for so long?
Well, I'd say I've always had, or for even before the industry, I've had an interest and a passion for investing, and that's kind of where it started. The CFA, doing those exams was kind of my path to get into finance, and led me into asset management after a couple of years working at another part of BMO. But ETF specifically was a little more accidental. I started on the quantitative side of quantitative equities, rules based, quant strategies. But the opportunity to join a growing ETF team was there many years ago, back in 2011, and took that opportunity and kind of have tried not to look back ever since. And ETFs have just grown and grown and grown in popularity, and so I got to admit, though, it was not a conscious effort on my part to become an ETF portfolio manager, but it just kind of happened, and it's been a great place to be, to see the growth of the market and clients just increasing their usage of ETFs. That's made it a really fun past 13 years.
The space has grown so much. I feel like there's constant innovation in the ETF space, so I'm sure it's exciting. And it sounds like you're really kind of into those, your focus is on a lot of the really intricacies of investing and those kind of beyond the basic stuff. So it seems like it's a good spot for you for sure. Before we get into our conversation, just a quick note to our viewers. Subscribe to our YouTube channel, TD Direct Investing, so you don't miss an episode of Inside Investing. Make sure to let us know what you think about today's episode and what else you'd like us to cover on the show. All right, let's get into it. Chris, can I have you explain how a covered call works?
Yeah, for sure. So usually covered calls are on equity strategies, not always, but I'll kind of speak about it in terms of equities. So what it does is it takes an equity portfolio. Let's use Canadian banks as an example. And you start with that as kind of a foundation. So your foundation is an equity-based portfolio, maybe 6 Canadian banks equally weighted. And then the covered calls are, a feature that's layered onto that. And what a call option is a contract that will deliver that stock, if it goes above a certain price. And in return for that feature, the writer of the call option, and this is what covered call ETFs do, collects additional income. So the covered call strategies, they start, with an equity portfolio. And then for, what it does is sells away some of the potential upside. So stocks go up. You may have a cap or lose some exposure to some of the upside, but in return for that, you receive additional income. And so, we'll get into all the details, but there's different ways to do it. How much you kind of, and how heavy you go into that cover call strategy, can really impact results. And we're gonna do the deep dive and get into the details today, which is great. But overall, they've been very popular strategies for investors who are looking for income, still want some equity growth, but really have that income need and want to take a little bit of risk off the table as well.
Okay, so perfect. Okay, so this is a good point. So you're talking about so obviously an equity strategy or an equity investment, but what type of investor would be attracted to this strategy?
Yeah, so usually the kind of the typical or kind of standard would be, an investor typically a little later in their kind of investing career, more like closer to retirement, perhaps in retirement, where these investors often have higher cash flow needs, perhaps not working as much or maybe not working at all, and have those cash flow needs on a monthly basis. Many investors, even, in retirement still want to have some exposure to equity growth. It's been great to see fixed income yields come up a bit, and that's helped, but now they're starting maybe to go back down a little bit in Canada. Cover call strategies can really help supplement that income. And beyond that, we see other investors like tactical investors who may not be, that classic, call it 60-year-old income investor, but more of a perhaps a younger investor, and just says, well, I think Canadian banks are going to be a little bit range bound over the next year, and I want to see if I can pick up a little bit of extra income if they don't move too much. Because in the cover call strategy, the only real give up or opportunity cost is if stocks rally. You'll tend to not participate as much. Depending on the strategy, you'll get some level of participation, but you won't get as much.
Now, that being said, covered calls can be done outside of ETFs. Investors can do covered calls. So why would you use an ETF as opposed to doing kind of individual covered calls?
I think there's a couple elements to there. There's a generic comment about ETFs, where obviously ETFs offer investors, generally speaking, kind of like a diversified portfolio, in a kind of a one-click solution. So, for example, like we have strategies on dividend-based portfolios, cover calls on dividends, like high dividend in Canada with a cover call. So you get exposure to 35 stocks diversified across sector. We screen the stocks. The manager controls the rebalancing and making sure, we're still staying invested in high quality dividend paying stocks, and then doing the cover calls on top of that. So, the ETFs offer that one ticket kind of solution. There's tax efficiency, and when we provide the transparency as well. So a lot of investors like those kind of generic features about ETFs. And then when you look at cover calls specifically, and, the way we do it in the cover calls is we'll sell calls against each individual position. But, when you think of kind of the legwork, we're going to have at least 35 options. And, like any, I think good investor, we want to diversify as well. So sometimes we'll have like 2 options per name. So when you look at this portfolio, 35 names, sounds kind of simple, but now we've got 35 equities to manage. Maybe we have 50 or 60 option lines to manage. So for the average investor, start to become, most people have day jobs, to attend to. In this case, this is our day job, for us here. So we obviously, spend, every day we're monitoring these positions and adjusting as needed. So, it's a big advantage, and, so that's, but we're always happy to share the wealth, share the knowledge. And we're supportive of anyone who wants to write covered calls, but a lot of investors do find it easy in an ETF framework to come to us to have us do, the heavy lifting.
Yeah, much less work. And when you say it like that, it really sounds like a big burden, especially for your average retail investor. That's great. And also, I mean, there's also low cost. Like not every investor would have enough money to buy 35 stocks, for example, especially in any significant amount. Whereas, really
Yeah.
low barriers to entry for ETFs in general. Yeah.
Yeah, that's a great
Excellent.
point, because each option, we'll just say, is it represents against 100 shares. So that's important if you're looking at options. If you're selling one option, you're selling away the upside on 100 shares. So the multiplier is 100. And so, it starts to add up with the more and more names you add into that portfolio. So definitely, that's something that we try to, try to offer, is just that, obviously take care of all that legwork. If you like the strategy and it's going to work for you and your circumstances, then we take it over from there and take care of all that legwork.
So what are some of the risks that are associated with these kind of high yield covered call ETFs?
Yeah. So, I think we already kind of touched on like what's the downside of covered call. If the underlying equities really rally and you're selling away some of that upside, well, you're going to forego some of that upside. So the question becomes, when you're looking at covered call strategies, as well, how much upside am I selling away? If you look at cover calls, you can actually generate 15, 20% yields or more, right? But the cost of generating the high yield is you're going to give away more and more upside. And if you really just keep going on that high yield, you might be eating into your principal to kind of pay for those high yields because it's got to come from somewhere. So, in terms of the high yields, especially, I think that's something to look out for from the investor perspective. Everyone likes a good yield play. Canadians like yield, and for sure, and as you should. But I think you want to keep into consideration like what's a reasonable level of yield. You take one step back, think about what you're investing in. I'll go back to the bank example, Canadian banks. So let's say the average return is 10% for the sake of argument historically. Well, if you're in a covered call strategy and it's distributing 15%, then how do you get from 10 to 15? Well, the only way you can get there is you have to sell down some of your shares to meet that high distribution. So so I think that's something investors can just look out for, and and look at not just yield in isolation, but look at what's the total return of an ETF. And you can go to the BMO website, has tools to compare these numbers, and it's not just BMO ETFs; it's the whole industry's ETFs are loaded into the system, and I'm sure TD TD has those tools as well on the platform. But look for the total return as well. Don't just look at yield in isolation. And then another way, some of those ETFs try and get to that 10, 12, 15% number is they write much more aggressive calls. And so what they're doing is they're giving away more upside because they're writing more aggressively to bring in more income. And where you'll see the impact of that, where you tend to see the impact of that is in the total return. Because if you look at over time, markets are going to generally rally over time, obviously volatile, ups and downs, but generally they will rally over time. But if you go back and look, okay, well, the banks were up 10, but my high yielding ETF, maybe it only gave me 5. And, you just have to decide if that's what you want to be in. So definitely, yeah, looking at the total return, and watching out for those over distributions, and, taking a step back and thinking, is it reasonable that, the equity portfolio I'm in is paying 15% yield? So certainly, keep an eye out for that.
So once the money's in there, you guys manage it, but we do have to do a little bit of legwork first to make sure that we're choosing the right ETF for us. So really kind of taking the time to look at them, understand kind of the intricacies of the ETFs, and then making the decision as to what kind of makes the most sense. There is still a little bit of work obviously involved in this process. The securities industry is highly regulated. Have there been any regulatory responses to these practices?
Yeah, so on the yield, we did see the OSC came in a few months ago. It was a reminder to ETF manufacturers, fund manufacturers, that it's not appropriate to sell a product just on yield. So that was the big thing. So obviously, if you see a 12% yield, you're going to be attracted to it. It's kind of that would be a natural instinct. And so some of the marketing was kind of, putting the 12 in big, bold letters and like, don't worry about anything else. You got a 12% yield. Well, you do have to look at other things. You have to look at how diversified that portfolio is. Is it giving you the total returns? Is the price level of that ETF or fund, is it just declining? And if it's declining, well, markets are, doing well or holding, at least holding steady, but you see the price declining. Well, that could be indicative that it's over distributing. So the regulator came in and they said kind of, you can't do this in like 28 point font, have the yield. And if you're going to include yield, you have to show total return as well. So that was a reminder. So definitely something the regulator is aware of to, try and help, ensure that investors are exposed to not just the pretty part of the picture, but the entire picture so they can make more informed decisions.
Absolutely. Yeah, it is attractive. You see this one piece and you sometimes you forget about everything else and you don't think about the rest. So it's important to make sure that we're showing investments in a realistic way, that we're not just focusing on one piece, because you're right, there's so much to consider. Another piece of this is leveraging, and ETFs in general can have this type of risk. So can you let our audience know what leveraging is?
Let's say, for example, there's $100 to invest in 6 banks. Well, you're gonna, if you do it equal weight, you'll have about 16, $17 per bank, and you put it into each one, and now you've invested all of your equity. So you're fully invested, but you've invested the 100. So it's not levered. You know what leverage is where you're getting a source of exposure that would take your exposure above $100. And there's different ways to acquire leverage in an ETF. In the covered call space, what's a little more popular is a light leverage, where they're going to leverage an extra 25%. And what they do in that case is they usually borrow cash. So they have $100 to invest, but then they borrow an extra 25. And you have to pay for that, like you would for a mortgage or whatever. So they're going to pay 5-6% on that borrowed cash, but then they invest that extra $25 into the ETF or into the strategy. So from an investor point of view, I think leverage is it's not necessarily a good thing, not necessarily a bad thing. It leverage magnifies returns both on the upside and the downside, which usually investors are more worried about the downside, as it should be. So that's something to keep in mind. And even on a 25% leverage, you're still going to amplify things a little bit. I think in the cover call space, what we've seen is, again, to that kind of yield chasing aspect of it, they've employed leverage to bump up the yield. So let's say it was yielding 10, and then you have 25% leverage. Now it's yielding 12.5. But we haven't always seen that cost to borrow. Like I said, it's going to cost you, we know it's going to cost between 5 and 6% to borrow that money. So that's not always reflected on the top line. The other thing I'd say about covered calls specifically too is covered calls are more of a deleveraging strategy in the first place. If you think about it, you start with equities, but then you're going to sell away some of that upside. You're going to get an extra income stream. So you've already taken those equities and making them a little more defensive. So, it's kind of strange to take a strategy, make it more defensive, and then lever it back up again. It's like, well, why don't you just go with the regular equity strategy? If
Right.
that's what you want to do. So that can be another thing to consider, because the worst case scenario with covered calls is that you're employing leverage, but you're foregoing some of the upside. So you're not necessarily getting the benefit of the leverage on the upside, but you're getting the negatives of the leverage on the downside. So, just something, just more things to consider. I think most investors, are probably just fine, without using leverage. And if you want to be a little more aggressive on your strategy, well, then that would take you, in my mind, out of the covered call bucket and into just the regular equity bucket. And then you
Right.
can kind of achieve that little bit of a higher risk tolerance, higher growth by doing that.
And I like how you kind of contrasted that to like a defensive strategy versus adding the leverage, because again, I haven't really thought of it that way. So it is kind of interesting that you're using those two kind of contradicting kind of sentiments. Fees. Always have to chat about fees specifically. So is this something that should be considered when we're talking about these covered call ETFs?
Yeah, I think you should consider fees for any ETF or mutual fund conversation. It's something to keep in mind. Because if you go back to that, okay, equities are going to give me 8% a year. Well, if you're paying 1% fees or 2% fees, that's a big hit out of an 8%. 2%'s like a quarter of the return. And we know the power of compounding that has over time. So I think you should always take a look at it. But I think the caution and my kind of 2.0 advice is, a lot of times you go to the website and you'll put in the ticker, and you'll go to the website and they'll say, well, the management fee is X. Let's say 65 basis points. And and you think, and somewhat rightly, in my opinion, that you've done your due diligence. Well, my word of warning, and this is for ETFs, is the document you really want to look for is called the ETF facts document. Every provider should have this on their website. So it's got a few different things, overview of the fund, what it holds, what the trading liquidity looks like. But they have a very great section on fees, and it shows you everything. So it's going to show you the management fee, and that's what you're going to see on the surface. But as you know, sometimes what you see on the surface, there's still other things. But other things you'll see is, okay, if an ETF invests in other ETFs, and those underlying ETFs are charging fees, it's going to show you the impact of that. If that ETF is, say, borrowing cash to provide that extra leverage, that extra yield, well, that cost to borrow should be reflected into there. And then, any trading commissions. So like we're trading options, there's going to be commissions. What's the impact of that? And so if you have say an ETF that's really aggressive on the calls, maybe they're selling more calls. Maybe they have increased commissions. So, it's a lot to put on to the investor, but I really think that ETF facts document is a great resource. And, it's interesting what you find. We have seen, in the industry cases where it'll say, well, it's a 65 basis point management fee, so 0.65%. But then you go to the document and the total fee is like over 2. So now that's a big swing from a 0.6 to a 2. So that would be, my other advice is to take a look at that document, ETF facts, and try to get the sense of the total, fee picture, and, whether you think it's a good deal or not. 0.6% sounds not too bad, but 2%, you start to think, well, that's a bit of a higher cost than I thought I was signing up for.
Those documents can be so helpful and really good for comparison, like you mentioned, and certainly the fund websites will absolutely have those as well. So whoever you're looking for the ETF from will have these documents available. You can even just type it in Google, the name of the fund and ETF facts, and it'll pop up for you. So that's for sure. There are sometimes that show like low or zero fees. Can you shed some light on that as well?
You see it a bit. The headline is it's a zero fee ETF. If I was a regulator, this would be something I'd be a little concerned about. I mean, nothing, as we know, nothing really comes for free. So you have to ask yourself, okay, where is the money being made? In some cases, what it is, there's zero fee on the ETF, but the other ETFs or funds it's investing in may be charging fees. So although we call it the top fund is not charging the fee, the bottom funds are you're incurring fees on those. Maybe there's a cost to borrow. There's other fees. So yes, technically correct. It's zero fee, but there's other underlying fees. So again, something to watch out for. If it looks too good to be true, it might just be the case. And that ETF facts document is a great place to see the total cost of ownership of an ETF.
We covered this a little bit, but let's just kind of break it down after going over everything. So there's a number of risks to consider that we've covered. So why would I not just create the covered call strategy without the ETF?
Yeah. So again, we touched on it a bit. You can certainly do that, but I think maybe I've given an impression. There's a lot going on under the hood, and all ETFs are simple vehicles, but sometimes the details get a little more complicated. So then, you look at different covered calls, you see how are they structuring those underlying equities. Okay, so you say, well, it's a high dividend ETF and there's 35 names, but what kind of names? Like, how do you select one or over the other? And different providers will have different methodologies. And then with the options, it's a very innovative, it's a very powerful market. It can help generate income. But again, it requires a lot of ongoing work and maintenance, and it's just whether you're prepared to do that. So again, you can do it yourself, and we've got content, educational content. We don't kind of make it a mystery what we're doing. We try to be transparent, but it's a fair bit. It's a fair bit to do. So that's the value add there.
Because of the risks and the fact that investors must use this strategy in the right market situation, would it not be easier to use just like a regular equity ETF across the board?
And I think that's something, an investor should always consider. So if you say, well, why cover call banks versus just the outright banks? Think about what you're trying to accomplish. And I think if you're a longer term investor, you can take on some risk, and you're going to hold the investment for, kind of like 20, 30 years or plus kind of thing. Probably the regular version, works better because you'll tend to get higher returns over time, and you're able to tolerate those risks. But the cover call is really designed for more the income oriented investor. And also because you're getting that income stream, it lowers your risk a little bit as well. You're still, I'd say, to be clear, you're still on that equity side when it comes to risk, but it's a little bit lower than if you hadn't have done the cover calls. So I think that's the right way to think about it is just what is what are you trying to achieve, and if it's income and meet a target and have a little bit of equity growth, perhaps that will shift to the cover call bucket. But again, the other thing, and I think it's implicit, but don't buy a cover call just for the yield or just because it's covered call. You really have to like that underlying exposure in the first place, and that's number one. So, but yeah, again, if you're 40-year-old investor, let's say, and you're RSP, probably you just would want the equity exposure potentially because it can give higher returns, and that can compound over the 25 years or however long it is till you retire.
And your portfolio doesn't have to be one thing. You can have a little bit of everything, right? So this may be a portion of the portfolio, but not all of it. So, depending on what your goals are and all that stuff. So lots of legwork to do, unfortunately, as a self-directed investor to figure out what makes sense. But again, you could choose it for one piece of your portfolio as opposed to all of the portfolio. It's all little puzzle pieces to kind of put the pie together.
Yeah, and I think the good thing for an investor is, I know TD has excellent tools. We've developed tools on our website and information and documents. So maybe it's overwhelming, but at the same time, we're trying to give as many tools and education to investors, so they can kind of help feel comfortable and confident, when they're making those decisions.
Absolutely. You're doing it yourself, but not alone. It's kind of like to think of it that way. We're trying to give you as much support as we can, but still letting you kind of make those decisions. All right, we're going to have to leave it there, Chris. Thanks for helping us to uncover the hidden risks of covered call ETFs and at the same time teaching us about their benefits. Our viewers can now consider these ETFs with all of the information. Any final thoughts you'd like to leave our viewers with?
Well, thanks for having me, and then great to be part of the program. Um, you know, I'd say my kind of go to nugget. I don't know if it's a nugget, but the only free lunch in investing, I believe, is diversification. So keep that well diversified portfolio. Figure out the mix that works for you. But yeah, I think having different exposures in a portfolio that can benefit in different environments, that's what helps create robust portfolios. And there's just so many ETFs that I think you can really craft, um, really bespoke and like very effective portfolios that are going to meet your needs. So that's my nugget. But yeah, avail yourself of all the tools it's that we have to offer, and keep dialing into to this program for sure.
Excellent insights. Very excellent insights. Thanks again for joining us. And for those in our audience, make sure to check out our full lineup of educational content. We have instructional videos, interactive masterclasses, and of course, more live webinars. Register now to continue your learning journey. And until then, see you all next time. Have more questions? Check out the links to the right and in the description below.